everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 428 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Well, today I just want to talk about being rich, right? And I want to talk about what some of the greatest regrets of people who actually become rich or become wealthy, what are those regrets? Right? And how can we learn from those regrets, not make some of the same potential mistakes that they made and actually reach, that wealthy figure that we're looking towards, or that retirement nest egg number that we're looking for, even quicker, even more efficiently, and actually become wealthy without having to learn some of these lessons the hard way, right? So I want to talk about the top regrets of the rich today, and hopefully we can take something from this and not become rich people who regret things later on, or even worse, not become broke people who have regrets later on, because I'm sure those regrets would be far greater. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately push you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, everything that I'm going to talk about today is from this Wells Fargo survey, and it is basically about those wealthiest investors out there. What regrets do they have, right? And when I say wealthiest out there, I don't want you to think that I'm talking about people who have money that is not attainable, right? That's not at all what we're talking about, right? The survey questioned almost 2,000 respondents that had 250,000 or more in investable assets. And having 250,000 or more in investable assets doesn't necessarily mean that you're super wealthy. It definitely means that you're above average. But it does not mean that you're super wealthy. I mean, try living on $250,000 of invested assets over a retirement. It's probably not going to be a fantastic, crazy good retirement, right? But these are people who actually have saved and invested money for themselves, and these are regrets that they have about money, right? And I think it's important. I think it's important for us to understand how others feel about money, things that a consensus group of people say and feel about money, because I think it can inform the actions that we actually take, right? Because how else do we learn other than either our own experiences or the experiences of others, right? There is no history of the stock market if it weren't for others' experiences. There is no understanding how to get wealthy if you don't actually see people who got wealthy, right? There's no understanding of how to ruin getting wealthy other than watching people ruin getting wealthy, right? So we need to learn from the actions of others. Now, these wealthy investors, they wish that they'd made better investing decisions. They wish that they'd saved more and spent less, stopped to smell the roses, all these different types of things. And we're going to dig into each one piece by piece, okay? So I don't want you to think in any of these examples that, oh, well, this is something that, I've already crossed this bridge. I've already made the same mistake. This episode's no good for me. No, because I think there are a lot of things here and mistakes that maybe you haven't gotten to yet, or especially for us younger people, mistakes that could definitely come later on that if we're aware of now, then we can go ahead and prepare for them ahead of time and hopefully avoid them along the way. That's really my goal here, is to help you to avoid things that you could easily step over, or make you realize things that you might be right in the middle of. So the first thing is avoiding mistakes along the way. So you may think that investing is easy, but wealthy investors might disagree. Right? According to those surveyed, the single biggest regret for those with six-figure portfolios is not having done a better job making investment decisions. That's pretty understandable when we consider that many of these investors built their portfolios during the internet boom and bust and the housing bubble and the pop and drop, right? So we need to understand that the investing decisions that we make are going to impact the money that we have later on, right? It is going to be very clear if you put, all of your money in something that ended up popping. That's going to be a big regret that you're going to have. It's going to be very clear in your portfolio returns that was a contributing factor, right? Now, if you invested in a very diversified way and did things slow and steady, and made these very thoughtful, semi-conservative choices about how you invest over time, you're probably not going to regret it. Or if you were too conservative with how you invested and only invested in preferred stocks and bonds, and only put money in savings accounts or CDs or whatever, then you may also have certain regrets about the investment decisions that you ultimately make. But now, because it's understandable that many made bad investment decisions, it doesn't mean that there aren't steps that you can take to minimize the regret that comes from certain decisions that you make. So there are some ways that you can limit the impact of bad investment decisions on your portfolio. And all of these things are things that I talk about and have talked about on this show in the past. So the first is investing in what you know. Know what you're putting your money into. Be knowledgeable about your investments. And you won't have any question what to expect in the future, right? If you invest in a fund and you have no way of knowing what that fund invests in, or even worse, you invest your money in a stock and you have no idea what the company does, then you're going to have a problem. So invest in what you know rather than the fly-by-night hot stocks with complicated business plans or no business plan or no revenues or no earnings or whatever. Invest in what you know. Then focus on building a long-term portfolio rather than short-term trading, right? You want to be a long-term investor, right? And a long-term investor will make better decisions than a short-term trader will. And it's been proven time and time again that will lead to better returns and more wealth for us over time. Then invest continuously and consistently rather than in sporadic lump sums that may or may not be timely. Whether you know it or not, a lot of people, they like saving up, lumps of money and then waiting for things to get hot. And ultimately what that's going to do is lead you to, these subpar returns over time, which is just not what we're looking for. We want to, be constantly investing, buying when it's high, buying when it's low, buying when it's in between, and then making that dollar cost averaging decision to just invest month after month, paycheck after paycheck. That's going to be best for our returns over time. Time in the market is going to be best than timing the market. Now, the last thing here is spend more time researching, whether that may be your ETFs and mutual funds, the funds that you're investing in, the accounts that you're putting the money into, companies, sectors, industries, the economy. That way you actually understand the risk return relationship that's associated with the things that you're actually investing in, right? So ultimately we need to just be more thoughtful, more active, more hands-on. And when I say active, I don't mean more trading. I mean the actual doing the work when it comes to our investments, rather than just listening to the hot stock things or putting money into stuff because it seems to sound good right now. We need to learn, we need to take long-term approaches and be consistent with the way that we invest, and we won't end up with this regret of making investment mistakes that kept you from being more wealthy than you could have been otherwise. Now, the second thing is making better financial choices. Now, although wealthy investors have built up substantial portfolios, many realize that if they'd done things like start investing earlier and make better decisions on spending, they'd have an even bigger stash set aside for their golden years. Thanks to the power of compound interest, the ability to earn interest on an investment and then earn interest on that interest over time. We've talked about that. I have episodes on that. Go check that out. Investing when you are young can result in a huge difference in your portfolio value as you age. So let's just take an example here, right? So the example would be investing $500 per month in a hypothetical investment with a 5% annual return over a 40-year period. Well, that ends up giving you a portfolio of $725,000 when over that 40-year period you would have invested what? Let's see, $500 a month is going to be $6,000 a year, $6,000 a year over a 40-year period. So what? $240,000 of investment. But you end up with $725,000. And obviously, if the rate of return's higher, you would have even more money. Now, however, investing that amount over a 20-year period would net you less than $200,000, right? So investing earlier would give you better results. And so you only cut that period from a 40-year to a 20-year, you cut the period in half, but the amount of money that you are left with is, almost down to a quarter of what you would end up having if you held it the entire 40 years, if you invested over the entire 40 years. So because investing early can make such a big impact on your financial future, it's little wonder why affluent investors wish that they become more frugal so that they could set aside more money sooner. So very clearly, right, you want to make better financial choices overall. Obviously, they focus on this idea of investing earlier. But how do we get to this point where we can invest earlier and effectively? We have to build some financial foundation like I teach on this show on a regular basis, right? We have to know where our money is going. So they were talking about better decisions on spending. Well, that would be budgeting and tracking your expenses and being able to make better spending decisions. And then having emergency savings, having no debt, right? Actually having money to put aside to invest. Because if you don't have any money to invest, if you're constantly making debt payments, if you're constantly falling behind because things happen and you don't have money saved in case emergencies occur, then you're not going to be able to invest, right? And that's the argument that so many young people make, is that like, well, I don't have any extra money to invest. Well, that's because you're in debt, you're overspending, you're not doing the things, you're not making the sacrifices that you need to make in order to be financially, free, financially successful over a long period of time. But it is so true. We have to invest earlier, and we have to invest more consistently as young people, because without doing so, you're just falling behind day by day by day. Because that idea of compound interest is an exponential curve, right? It gets parabolic. Tracking the growth of your investments is not going to look like a straight line up and to the right. Far to the contrary, right? It is going to be this thing that at the beginning starts off with like this slow little amount of growth, and then over time, if invested in something that makes a historical return on average with the stock market, it will continue growing and growing and growing. And the reason that it would look like that curve instead of just being some shallow straight line is because 10% growth, for instance, on $1,000 is $100, right? So if you make 10% in a year on $1,000 investment, that's $100. But then once you get to having $100,000 and you make that same 10% in the exact same investment, then you're going to make $10,000, right? So the dollar value is growing at an exponential rate of your investment. So that regret of making better financial choices, investing earlier, tracking your spending, those are all things that we can do. And if you follow something like the financial action plan, that can help you to do that in an effective way and to become wealthy far sooner, and to actually become wealthy at all because you just followed a simple, consistent plan over time. Then another regret, they called this all work and no play. So 15% of wealthy investors wish that they'd stop to smell the roses a bit more along the way so that they could enjoy their money more. Although hard work can lead to financial success, taking time to recoup and rejuvenate can lead to a healthier and happier life. One way to do that is to spend less money on material things and more on experiential things such as vacations. People who spend their money on experiences rather than goods get the most long-lasting enjoyment. That suggests that taking a family trip is, in the long run, more rewarding than buying a fancy car. Interestingly, taking time to enjoy your money in this manner may be a good investment. And they even quote this research project that was done that said that people who take more time off, vacation time, tend to get promotions and make more money too. So I guess people with their priorities straight, their priorities in line, actually are more successful. So that's very interesting. So I think this is something that, yes, it's a money thing, but it's far more than a money thing as well, right? This is just this idea of not letting your entire life be your work, right? Not letting your entire life being so serious about your money and penny pinching, or even on the other side of that, just going out and buying nice things and wasting your money on whatever. This is basically saying, hey, have money set aside to do things that are going to be experiential and that are going to be enjoyable and that are going to be fun over long periods of time, that you will remember, that you will store in that memory bank, because at the end of the day, that's all you got, right? All you've got is those experiences, because a car will break down, a car will get traded in, a car will get sold or whatever. But the things you do with your family, with your kids, those types of things will not go away. And those are investments that you can make over time in the people around you, which I think are very, very valuable. And ultimately, I don't think any of us want to regret the fact that we didn't spend more time with our family. I don't think any of us want to regret the fact that we just wasted our money on whatever. I also think, and many people have this regret, and I don't think anybody wants to have it, but so many people do. I don't want to have the regret of just working all the time and never stopping to enjoy what I've done. That's the thing about teaching people about their finances and about their money, that is a very thin line, right? A very hard line to walk, because you don't want to tell everybody like, hey, just go spend all your money, right? Because that's not the point, okay? But you also don't want to tell people like, hey, you make all this money, don't spend any of it, because neither of those things should be the case, right? What we should be doing is we should be giving, saving, and spending all in some proportion relative to the income that we make and the expenses that we have, okay? All based on whatever your life situation is ultimately looking like. So it's important that we actually do all three. It's important that we spend money. Now, when we're in the portion of the financial action plan where we're worried about getting out of debt or building up an emergency fund, you don't need to be spending a lot of money on just frivolous, dumb things, right? But over time, as you build a financial foundation, you have no debt, you have an emergency fund. I mean, yeah, having money to spend on things is fine, is good, as long as we're not doing anything in a way that is unhealthy or is not going to be beneficial to us and our family over a long period of time. Then by all means do it, but just do it in a proportion that is going to be relative to what you actually have. Because for somebody who's a multimillionaire to go out and buy, let's say, I use this example, I think in yesterday's episode, a $50,000 truck, right? You go and buy a $50,000 truck when you've got a $5 million net worth. Well, it's not a big deal, okay? That's not a big deal relative to what you have. But if you are somebody who goes out and you buy a $50,000 truck and you have no net worth and make $50,000 a year, then you may be in trouble, right? It's not proportional. It's not smart. So I'm not saying don't spend money. I'm just saying do it in proportion with where you're at, and do it in a way where you can take some breaks. You can enjoy your life, because money is nothing more than a tool for us to enjoy our life. Whether we're trying to enjoy it by giving to others, by enhancing the lives of others, whether we're investing it for our future and for the future of others so that we can enhance our future and their futures, right? And or if we're spending it today so we can consume and we can enjoy things that are going on right in front of us, right? Ultimately, it's just a tool to help us to enjoy ourselves, right? But we have to do so in a responsible manner. Now, every investor is bound to have money regrets down the road, but minimizing these regrets can help you amass a larger portfolio and live a happier lifestyle. Although there's no guarantee that following, what these people have advice for will lead you to riches, it's probably a pretty good place to start. Now, these are just general financial regrets, but I want you to also consider investment regrets, right? Things that people have invested in, ways that people have invested that have gotten them into trouble, and things that they regret. And so if you look at the regrets that people have about investing, most of those regrets really come down to timing. It comes down to what we were talking about earlier with starting earlier on with your investing. So American investing regrets. These are from most common to least common. Okay, this again based on a survey by Magnify Money. And this starts with not saving for retirement sooner, 31%. Okay, again, there's no surprise there. Okay, not investing in stocks sooner. Again, I think this comes down to understanding the stock market, understanding what stocks are, understanding the value proposition that stocks provide over long periods of time in portfolios. So 24% said not investing in stocks sooner is a big investment regret. Then not purchasing a certain stock earlier. Now, 21% said that. But that can kind of be said tongue in cheek from time to time because, of course, we all regret not buying Amazon's IPO or Tesla's IPO or, Apple's, whatever, right? We all regret not buying and holding a stock over a long period of time. But the truth of the matter is very few people actually do buy and hold a stock for that entire time, right? They get rid of it, cut their gains at some point, or they may have taken some losses and gotten out on those losses and not held it through. So people may regret that, but that's not a regret that's going to hold you back from being wealthy over a long period of time. So whatever that may be, I don't think we can regret not purchasing, right? But this next regret, I think, is a regret that kind of goes hand in hand, and it's selling a stock too early. Now, this can be a legitimate regret because you can sell things based just on the fact that they've gone up in value, and you can not hold them when they actually had value that was still underlying over a long period of time, right? The story didn't change, but the price did, and so you sold. So selling a stock too early is something that can be legitimate, but it can also fall in that same idea of, not purchasing a certain stock earlier, right? You could sell with a basis, with a reason to sell, and then something continue to boom in price. And then, you don't look like the smartest person, but that doesn't necessarily need to be a regret that you have if you had a reasonable basis for selling. Then another regret, holding on to a stock for too long. Again, kind of falls in the same bucket, but holding on for too long, 14% of people say that. 14% of people also say that they regret taking money out of retirement accounts. Now, I think this is interesting as well because taking money out of a retirement account is going to do something that is really a multiple whammy on you, okay? One, it's going to take money that's growing for you, assuming that money is actually growing in good investments, and take that money and you will consume it. Right, so you're taking money out of that account and you're consuming it, okay? So it's no longer growing for you. You've lost that future rate of return that you would make. You've bought something today. You've consumed it today, okay? So you lose future growth. Not only do you lose future growth, most retirement accounts are also going to be tax advantaged, right? So you lose the potential to defer capital gains or to have tax-free growth on your money, right? So not only do you miss growing your money, you miss growing it with no taxes. Then also, when you're taking money out of a retirement account early, right? Then you're also likely going to be hit with some type of penalty. And that's assuming it's not like a Roth IRA, just the contributions or whatever. You're saying, maybe you take money out of a 401k or you take a 401k loan or whatever, right? All those things, just bad things to do, and it's no doubt that would be a big regret because it is going to set people back in their investments. Then 9% say not monitoring their portfolio, right? So being asleep at the wheel with your investments is a big regret that people have because I know I've heard of tons of people who just say, I just put money into my 401k. I didn't even look at what it was invested in. And then you look and you go, oh, it's some, stable fund or it's not really growing or it's some, just something that's not really going to do well over a long period of time. And it's not, that has no proven track record. It's, commonly held within a, 401k or whatever. Some may put you into something automatically that's okay, but very often it's not going to meet what your actual needs are. So if you don't actually monitor what you have, you can end up having some real big consequences in many different ways. Then putting too much money in an individual stock, 9% also said that was a regret, which that can be very true. That just means you're not diversifying well, which not diversifying your portfolio, 10% of people said that they regretted that. Trading too frequently, 7% regretted that. And typically trading too much is going to lead to less in the way of returns, so no surprise there. Not using an investment advisor, 7% regret that. Also, not super surprising because investment advisors can help you to learn, can help you to be guided through this particular process that is difficult for some people, and that is not just an easy something to go through. Now, this last regret that they have stated here, 7% of people said that they regret basing investment decisions on the news. And let me tell you, you're not the only one if this is one of your regrets, because I think many people, including myself, have watched people on CNBC or wherever else make a convincing case for a company or something, and you thought to yourself, I'll buy that company, that'd be great. And then it ends up being a flop, or it ends up being something that's just not going to turn out well for you. And so I do not recommend investing based on the news or on any investment advice that's not from a registered advisor or CFP or CFA, whomever you are trusting to work with you on your investments. So ultimately, there's a lot of regrets, right? There's a lot of investing regrets. There's a lot of just general financial regrets that people that are very wealthy have. And we just need to do our best to stay out of these things, right? If a bunch of people regret them, that means that, finding the silver lining in them is going to be very, very difficult, right? It's going to be difficult to stay away from the negative impact that doing these things can have. So let's just keep from doing them altogether, right? Let's keep ourselves on the financial straight and narrow. And let me tell you, being on the financial straight and narrow can be boring from time to time, right? It can be boring to do the things that are actually going to be beneficial over a long period of time, whether that be in your investing life or just your financial life in general. But those are the exact things that are going to turn you into somebody who is wealthy, somebody who has financial freedom, and somebody who can look back and say, I have no regrets as to how I lived my financial life. Of course, we're all going to have mistakes that we make. We're all going to learn by doing, and sometimes that doing is not going to be the best of doing. But the hope is we can minimize those mistakes, minimize those regrets, and be the best off financially that we could potentially be based on good actions, based on a plan, and based on doing consistently good, financially smart things over long periods of time. And that's what I want for every single person who watches this episode. I want you to be financially free. I want you to be financially successful. And that is a long-term commitment to making good financial decisions that hopefully I can help you do. And hopefully so can the regrets of those who have done things the wrong way. Hopefully that can motivate you to do things in the right way. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.